how do we get expected values of asset returns? And what does expected value actually mean? Well, I kind of classify expected values into two categories. The first I call the unconditional expected value. And the formula for that is quite simple. I take the historical data on returns and calculate the average. So the historical average is what I consider the unconditional expectation. Now, when we do that, and the reason that it's called unconditional is that it's not conditional upon information that's available today. So if I take the returns on, let's say, the US stock market from 1926 to today and figure out what the average return is, that really has nothing to say about the particular economic conditions and financial conditions that exist today. The unconditional expectation simply tells me what the historical average return is. Indeed, it treats every observation from 1926 to the present equally. It applies an equal weight. And that's just how we take an average. Now, in tactical asset allocation, what we really care about is the conditional expectation. And that expectation is our best guess of the return for the next period. And it's going to be conditioned upon information that's available today. Fundamental information about the economy, about the firm, anything that's relevant economically to figuring out what the forecasted value is for this return. Now, in this course, we study one particular way to specify conditional expectations, and there are many ways to do this. But the simple way that we do it is with a regression model. And let's think of a regression model right now, a simple model, where we're forecasting the return on a security for time t, and we're regressing on just one variable that we consider important. For example, the spread between long-term and short-term interest rates at time t minus 1. Remember, in a forecasting model, our explanatory variables are at time t, and our predictor variables are at time t minus 1. So this is a simple regression where we regress the returns at time t on an intercept, and let's call that d0. And there's a slope coefficient on the lagged spread between long-term and short-term interest rates, and let's call that d1. To get the conditional expectation given my regression model, all I do is to take the fitted values from that regression, the forecasted values. And to get my conditional expectation one period ahead, I would take the current value of the spread between long-term and short-term interest rates, multiply that by d1, my slope, and then add the intercept. This delivers the forecast, the conditional expectation. And if you look at all the fitted values in my regression, you'll notice that they change through time. As that spread between long-term and short-term interest rates varies, so do my forecasts for the expected return. So a conditional expected return likely changes through time. The unconditional expected return is likely constant through time. So this makes sense in terms of our tactical asset allocation, that we will be using conditional expectations. These are our forecasts of returns, our best guess of returns based upon the current information. They're conditional upon that information, and they are by construction time varying.